Hello, and welcome to the Basics of Investing, presentation by Mark N. Rogers, MBA. Disclaimer: I am not a certified financial planner, advisor, nor a certified financial analyst, nor an economist, nor a CPA, nor an accountant, nor a lawyer. I am not a finance professional through formal education. I am a man who believes and takes pride in a sense of freedom, satisfaction, fulfillment, and empowerment that I get from being financially competent and being conscious, managing my family's money. The contents of this presentation are for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. By using this information, you agree to hold me harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information found in this presentation.
Learning about investing is a lot like learning to ride a bike. Complicated. Dangers seem to be everywhere. That's why it's important to learn the basics and ways you can help minimize risk and protect yourself. After a good amount of practice and learning, start riding. Along the way, the roads may change. There'll be good days and bad days. And while learning to ride doesn't guarantee you a spot in the Tour de France, riding a bike could get you where you want to go a little faster. Let's start with the basics and look at one of the most common investments: stocks. A stock represents partial ownership of a company. When you purchase a stock, you're buying a piece or a share of a company. By owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. There are two ways you can make money by investing in stock. The first is through stock appreciation, when a stock you own goes up in value. If an investor bought the stock at one price and the price went up, the investor could then make money by selling the stock to another investor at the higher price. The second way is through a dividend. This is a periodic payment issued by some stocks. A dividend is a way for a company to give a portion of its earnings to shareholders. Here's an example of how stocks work. Suppose there's a company called Bull Flag Cycling. This company makes bikes, really good bikes. The bikes are so good, in fact, the company wants to expand, so it can sell more bikes to people all around the world. To do this, the company needs to raise money, also known as capital. There are a few ways this company could do this. It could take out a loan, but that would mean taking on a significant amount of debt. Or it could issue shares of stock. By issuing stock, which is called going public, the company can raise money without going into debt. Instead, it sells shares of ownership and a claim on future earnings to investors. So let's meet a typical investor. Our investor is someone who has a little extra cash. He's looking for an investment that has the potential to offer better returns than a savings account, and he is willing to accept the higher risks of investing in a stock. He thinks Bull Flag Cycling is a promising company that's likely to grow. Because of this, he thinks buying a share would be a good investment. So how much does a share cost? Suppose the company decides to raise $1 million, and it decides to issue 1,000 shares of stock. Because each share represents a fraction of the company's worth, and there are 1,000 shares, each share represents 1/1000th of Bull Flag Cycling. Because the company is raising $1 million at the initial public offering, or IPO, each share would be initially valued at $1,000. Let's suppose the price doesn't change after the IPO, so our investor purchases a single share on the open market through his online stockbroker for $1,000. Now, let's see what could happen to his investment. If the company does well and profits increase, the value of the company is likely to go up. As a result, the stock price may increase as well. Assuming the price of the stock goes up, our investor could now turn a profit by selling his shares to another investor in the stock market. However, if the company's ventures don't go as planned, its value could decrease, and so could the stock price. If this happens, our investor could lose money if he decides to sell at the current price. When it comes to investing in the stock market, the basic goal is to buy when prices are low and sell when prices are high. But stocks in the stock market don't always go up. Sometimes they stay the same, and sometimes they go down. And sometimes prices change quickly. Because of this, stocks are considered riskier than other historically safer investments such as bonds or CDs. However, investors keep coming back to the stock market. Why? Because with this increased risk comes the potential for greater returns. Savvy investors take precautions to try to minimize risk, like creating an investing plan, adding diversity to their portfolios by investing in a variety of companies, putting money in other investments besides stocks, and learning trading strategies for up, down, and sideways markets. Now you know some of the basics about investing in stocks, but that's just the beginning. Open an account with TD Ameritrade for access to more award-winning investing education.
Hello, and welcome to the Basics of Investing. Disclaimer.
Hello and welcome, new investors. My name is Cameron May, and if you've never even
Things to know about investing. Number one, the stock symbol. What is a bid and ask? The market hours of operation, due diligence, and charts. To look at an example of a symbol, bid, and ask. Here we have one of my favorite stocks, Phi Group Incorporated. The stock symbol here is PHIL, P-H-I-L. Here you have the bid and the ask. The bid is the minimum amount to purchase a stock. The ask is the asking price per share of a stock. Keep in mind, before market hours, you could only purchase at the ask. This is also at the close of the market, in which you can also purchase at the ask. Throughout the day, you are welcome to try to make a bid on the price. However, in most cases, the sale will not go through unless you meet the asking price for a stock. The market hours of operation are typically Monday through Friday, 8:30 Central Time to 3 p.m. Central Time. I'm saying that time simply because I'm located in Memphis, Tennessee. Also keep in mind, the market is closed on federal holidays. So what is due diligence? I'm always seeing this DD everywhere. Or due diligence is defined as an investigation of a potential investment, such as a stock or product, to confirm all facts. These facts can include such items as reviewing all financial records, past company performance, plus anything else deemed material. Here are a few sources that I use for due diligence. Investor Hub is going to always have a plethora of information researched by other people investing in a particular stock. Also, StockTwits is also a reliable resource, but keep in mind, on both of these programs, you always have to go and just double check just to make sure that what you're reading is legit. Macroaccess.com is also a unique tool that allows you to organize your portfolio, also see the volatility of a stock, as well as also see the potential valuation. You can see if a stock is undervalued, overvalued, or if it's right where it needs to be. It also allows you to import your portfolio just as Yahoo Finance does. I also recommend using Seeking Alpha. Seeking Alpha has a similar usage as macroaccess.com. It looks at the potential valuation and whether or not the stock is worth investing into as well as the potential profit that a stock could have at a particular price point. Also, just keep in mind there is no greater source than the SEC. For many pink sheet or over the counter stocks, the SEC requires them to have certain documentation before they are current on the market. Some pink sheet or OTC stocks actually have been stopped permanently by not meeting the standards outlined by the Security Exchange Commission. So here are a few tips that I would like to recommend to you before you invest in the stock market. Number one, buy low, sell high. Do your own research or due diligence. Diversify your portfolio. Don't live just by one stock. Practice risk management. Know when to sell and know when not to sell. Extremely important. Don't watch the market every day. This can be very stressful, especially if you know that a stock is going to make a huge profit within the next 2 to 3 months or even within the next day. Just keep in mind that anything could change overnight. Stock never consistently goes up, but also it doesn't consistently go down. And remember, you do not lose money until you sell a stock after it's already dipped down. Also, don't buy and sell the same day unless you have over $25,000 in your brokerage account. This could result in a day trade, and if your account is less than $25,000, typically you are only allowed to do what's called 3 swing trades per day. So please be careful and mindful not to do that. And last but not least, share knowledge. Get connected with like-minded individuals. Join the Barrier Breakers group on Facebook. This is a group where I have invited many of my friends, colleagues, acquaintances, associates to join in to break barriers right here in our communities nationwide and worldwide, because investing is a tool that is designed for everybody. So let's not just limit it to just one set group of people. It's our turn to break those barriers and teach other people how they can invest in the stock market and create a life that many have desired to have the right way through investing their funds. Stock charts are also important signs for our investments. Let's view the YouTube video on how to read stock charts for beginners. This video is expected to last about 8 minutes long.
Let the muddled masses manage their money using their pre-Mesozoic means. I pay them no mind. I am my own maestro of money management. My money maneuvers at my mandate with no monkey wrenches thrown in the machine. My mind.
Hey, this is Sasha. Welcome to another episode of Let's Talk Stocks, episode number 202. And in this episode, we're going to take a look at how to read a stock chart for beginners. So if you don't know how to read a stock chart, this is what this video is going to show you. It's how to read a stock chart and the basics of it. So let's take a look at some of these charts. So here on screen, we have a line chart. Now, this chart right here is a chart of Apple. And the way that charts are really constructed in the market is what we have is the price usually on the right, and sometimes it'll actually be on the left side as well. So price is actually on the right or left axes, And then you have the time axis that's on the bottom. So this chart is a longer dated chart from 2010 all the way to about mid-2018. And if you take a look at the current price, you basically line up today's date with the price, and that'll give you about 218.28 for the Apple chart. Now, if you want to go back in time and see, well, what was the price at the beginning of 2016? Well, you take a look, go straight up to 2016, draw that line across, and you can see price was right around about $100 per share. Now, there are different types of charts out there in the stock market. You can look at data in all sorts of different ways. So if you take a look at some of these other charts, here we have an area chart, which is very similar to what you saw before. It's just that things underneath are filled in. You can also look at things with here's a candlestick chart. Now, this is the typical chart that is used in the market, or what most traders and investors look at, and that is because it gives you more data or signals. And what it really does is it tells you in every single one of these bars, the high, the low, and the open and close, basically the way that it wiggled around throughout that time period. So this is actually, if we look at this, it is a monthly candle. So every single one of these is a month. So it tells you the lows, the highs, and where it opened and closed within that month or time period. That way you're not just getting a dot of where the price closed at the end of the month. Instead, you get to see the magnitude or the movement of wiggle room also within that month. And that's what it really represents. If you look at this bar chart example, or the open, high, low, close chart example, this does the same thing. I find this is a little bit easier for people to digest when they're just getting started, because if you take a look at kind of this bar here, you can see, okay, we opened here, we got down to a certain price level, we got up to a certain price level, and then we closed over here. So it's kind of an input-output kind of model of where you start the movement, the wiggle amount, and then where it exited. So that's really what the chart kind of looks like. Let's take a look at the candlestick again. So here I want to share with you an example. This one is McDonald's, also a monthly time period. And you can see here we've digested from 2012 to about 2015, 2016, moving sideways, and then price took off. So you can see there we went from about $100 per share, moved a little bit higher, and then pulled back a little bit in 2017, and then again continued to power higher into higher prices as we got into 2017 and 2018. It's just moving a little bit more sideways, or digesting the move again. So that's kind of how you're looking at charts and reading charts. So you can see periods of digestion, periods of acceleration or movements higher, and it allows you to really just spot the price differences across multiple time frames. Looking at this time frame, and Tesla, here we have 2012 to 2013. You can see a digestion period. At that time point, the price was right around $30, $40 per share. After 2013, we started to get a ramp up in prices. Price got into these highs around September, October, and we were at about 180, 190 per share. We then had a little bit of a pullback right before we got into 2014. We pulled back to about $115, $120 per share. And then again, the price bounced, and we got into higher prices of about $250 per share. Now, as you look at some of these swing points, which are basically where prices change directions, you can see we're creating kind of a support level or support line. So in May of 2014, we've hit that support level of about 175. We've done it also in 2015. Right before May. We've broken beyond that support level early 2016, but then managed to get back above it. And then right around late 2016, maybe December time, we've hit it again to hold that support level. So you can see how stock charts are really handy to see, hey, where is that supporting price level? And you can also see some resistance levels as well. Where is the stock struggling a little bit at higher prices? And here with Tesla, you can see, again, around September time of 2014, we're hitting higher prices of about 275, where the stock struggled again. In 2015, about June, May-June timeframe, and then also early 2017 as well. So it gives you an indication here of how to really look at the chart and read the chart. In simple terms, you got price on one of the sides, usually the left or right axes there, and then you have time on the bottom side. And then combining these together, it allows you to match up the time with the price, and that'll give you an indication of what the price was at a certain time period. And if you're looking at bars or candlesticks like this, it allows you to see how much wiggle room was there for that time period. For example, a month, or you could do this also on a day basis. So here, if we're looking at Amazon on this chart, you can see right now we're on the monthly time frame, but I could change it to a weekly. So now you're seeing each bar is a week, or on the day, how much wiggle room was happening in the day time period. So anyways, I hope this was helpful and insightful for you if you're just learning the basics about reading stock charts, to give you some insight on looking at them and evaluating them. Of course, there's many more things to learn about stock charts, such as what's underneath the chart. So if we look here, actually, give you a quick little insight. And looking at this lower level, this here is the volume. Okay, so that is the amount of shares traded. So think about it, stepping on the gas pedal, how much fuel is there, right? So that's really what that tells you. And you can add more indicators like little lines here that you might see. These are the average of that line. Same thing on the charts themselves. You could put an average moving line from a 20-day, 50-day, and you can manipulate those and adjust those to your liking. Anyways, thank you so much for joining me. If you want to subscribe to our newsletter, click the button over here. Get on the newsletter by entering your name and email address. That way you get other free training when it's released.
So basically
Product,
here,
services, and coaching.
one moment.
Otherwise, if you want to just continue joining us on YouTube, hit the subscribe button right here.
So basically we have discovered just the pure basics of the stock market. So I want you guys to take this information, feel welcome to share it. This is an awesome opportunity for us all to win together. Let's break some barriers, let's educate our people, and let's make this money. So let's go secure the bag, y'all. Spread some knowledge, be blessed. Appreciate you for tuning in. Peace.